Kia ora koutou. Welcome to Shared Lunch. My name is Gus Watson, Investments Lead at Sharesies. Today we're going to look at tax on foreign investment funds, also known as FIF Tax. If you have over $50,000 invested internationally, this explainer episode is something you should listen to. To make sense of it all, I'm joined by Haydn Clark from IRD and Ross Nelson from PwC. But before we start, I need to tell you that the tax comments in this podcast are general in nature and for educational purposes only. We recommend you confirm or seek tax advice on how the tax law applies to your situation if you're unsure at all.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Thanks for being here, guys. FIF. It's this weird acronym. What is FIF? What does it mean?
Right, so the FIF rules is really the short term for the foreign investment fund rules, and it's one of the key sets of rules that applies to outbound investment from New Zealand into foreign companies, particularly outbound investment into foreign companies that aren't controlled by New Zealand residents. And so that means they cover your typical scenario where you've got a New Zealand resident investing into an offshore listed company where they just have a portfolio interest of less than 10%. And one of the things that these rules are intended to do is to ensure that those outbound investments in foreign shares are taxed consistently, including where, for example, the foreign company doesn't pay out a dividend.
As an individual investor, how do I know if the FIF rules are relevant to me?
As Haydn said, these rules apply to investments in foreign companies. So if you've got an investment in a US listed stock or anywhere in the world, these rules are potentially relevant, but they also apply to foreign unit trusts. What they don't apply to, I suppose, if I just touch on that, is cryptocurrency. Typically will not be subject to these rules, and there's some great IRD guidance around how you're taxed on your cryptocurrency. They're not relevant to things like foreign bank accounts, foreign investments in property, not relevant to your KiwiSaver. So there's lots of things they're not relevant to. But yeah, if you've got investments in foreign shares, then they're generally relevant, but there are a couple of important carve-outs to that.
Yeah, I understand that some of the ASX shares, they're not relevant for, and the IRD website is the best place to check that?
That's right, yeah. If you've got investments in Australian listed shares, then many of those are carved out. There's a specific exemption for them, but not all of them. So yeah, you do need, again, the IRD's got a great tool on their website. You just go to that, put the ASX ticker in, and that'll tell you whether or not that share is exempt from the FIF rules or not. I suppose the other key exemption is the de minimis exemption, and that will be relevant for many people as well.
Can you explain what you mean by the de minimis exemption?
Where you've got a total shareholdings in FIF of less than $50,000 New Zealand, and that's a cost test, so you need to know what you've paid for these FIFs, then the FIF rules do not apply to you, and you're taxed more or less as if they were an investment in a New Zealand listed company, for example. So you would be taxed on those investments on any dividends you receive from them. We don't have a comprehensive capital gains tax in New Zealand, so for most investors, you wouldn't be taxed on any gains you realise, although that's not always the case. If you're trading or purchase those shares with an intention of sale, then you'd be taxed on them. But yeah, for most investors, if you're in the de minimis exception, then you'll just be taxed on your dividend income. It's a cost test of less than $50,000. A couple of things on that. If you are investing using various platforms or different portfolios with different brokers, you do need to look at all of your FIF interests in total. If you're investing jointly, if you might be investing with your spouse, then you effectively you get $100,000 de minimis because you're splitting that holding across the two of you.
I'm an individual investor, individual New Zealand investor. I have been investing offshore. The foreign investment funds I've been investing in offshore, aren't on the exemption tool. It costs me more than 50,000 New Zealand dollars to buy these foreign investment funds. What do I do now? Like, how do I calculate my foreign investment fund income? How do I determine the tax that I might need to pay?
Sure. Yeah, well, there's a number of different FIF income calculation methods, but by far and away the most two common ones are the Fair Dividend Rate method and the Comparative Value method, the CV method. So FDR and CV are the two key methods. Under the FDR method, you basically take 5% of your opening market value of your FIF portfolio and take 5% of that, and that is your FIF income for the year. Now that's the case irrespective of whether that portfolio might have returned 15% that year. Your kind of income is capped at 5%, but in contrast, if it's a bad year and that portfolio has made a loss or a gain of less than 5%, you still have that deemed return of 5% under the FDR method. There is a little wrinkle to the FDR method as well. If you happen to be buying and selling FIFs within an income year, then there's something called a quick sale calculation. So if you are doing that, there's a little bit of complexity you just need to navigate, where you need to calculate the gain you make on that trade, but again there's a 5% cap. So a little bit of a wrinkle if you are sort of trading within an income year.
Can I replay that one back to you? So the FDR method, our first method, at a high level, I look at the value at the start of the period, I multiply it by 5%, and that's my FIF income.
Correct. The FDR method is available to all investors effectively. So if you were a New Zealand listed PI, the New Zealand listed PI would be applying those FDR rules to calculate its return on interest that vehicle might have invested into. As an individual or for certain trusts in New Zealand, you also have the ability to use the CV method. Under the CV method, it basically calculates the market value movement of your portfolio for the year. So, and for most investors, what you would do is calculate your income under FDR, calculate your income under CV, and each year you have the option of choosing the lower of those two. So in the scenario I described earlier, where your portfolio had performed poorly, under FDR you would have a deemed return of 5% of the opening market value, but under CV, if your actual market value movement was less than 5%, or in fact if you made a loss overall, then you'll pay tax on that lower amount. Where it's a loss, you don't get to claim the loss, but you'll return nil income on your portfolio under the CV method. Just one last thing I should say on that is that there is a consistency requirement. So if you have, you need to use the same method for your FIFs in an income year. So you can't sort of use CV for this lot over here because it suits you and use FDR on this lot. You need to use one method consistently within an income year. But you can switch and change between FDR and CV between different income years.
Or the decision for most of our Sharesies investors will be do I want to go FDR or do I want to go CV? So something that we actually offer Sharesies investors at the moment is download a report. So it gives them data or the inputs so they can do the calculations to determine their CV income or the FDR method income. It's a downloadable CSV report. Or we also offer a integration to Sharesies plugin. We share them a bunch of your trading data and it prints out those two numbers, and then you can make that call about whether you want to use the CV approach or the FDR approach. So summarizing, going back through, so we realised we're a FIF investor because we have more than 50 New Zealand dollars offshore. We've now done our CV income, our FDR income, and we've decided that we want to go with the FDR income approach, let's say. So how do we go about paying tax now that we know this number? Haydn?
Right, so obviously the thing to do is to include the FIF income in your income tax return. And so you would go into My IR and load up the return for the year and include your FIF income. When it comes to FIF income, you may be entitled to claim some tax credits against that income. For example, if you receive a foreign dividend and the foreign country has withholding taxes, you'll be entitled to a foreign tax credit in relation to your FIF income. But there are some limitations in claiming foreign tax credits, so it's always good to check the IRD guidance to see if you're entitled to the foreign tax credit and the amount you're entitled to. Then in addition, in relation to the dividend, Sharesies may deduct withholding tax, and that's resident withholding tax from the dividend. And you're entitled to claim a tax credit for that resident withholding tax in your return as well. The difference between a foreign tax credit, though, and the resident withholding tax deducted by Sharesies is that resident withholding tax is actually a refundable tax credit. So if it turns out that the tax payable on your FIF income is greater than the foreign tax credit and the RWT combined, you'd be able to get a refund of the excess RWT. If, I suppose, you realise that you'd not returned FIF income in a prior year when you should have, the best thing to do then would be to write into Inland Revenue telling them about it and making what's called a voluntary disclosure. And so again, you can do that through My IR by logging into the system and asking Inland Revenue to adjust the return. And when you're asking for an adjustment, it's really important to provide a work paper explaining how you've calculated the amount that you're planning on adjusting to. And also to bear in mind that you may have mistakenly included your dividend income in your return by mistake. So you're not just asking to include the FIF income, but you're also asking them to take the dividend income out the return. And so there's actually a net adjustment that you're asking for. So including all that information when making the voluntary disclosure is helpful.
There's a few things there to remember in terms of types of income. What happens with dividend income?
Well, yeah, under the FDR method, you don't look at dividend income. Under the CV method, there is a formula. So I said before that you're looking to work out the market value movement on your portfolio. It's basically looking at the overall economic return. So there's a CV formula that you need to work through. Your dividends form part of the gains for a particular year. So you would need to look at that if you're applying the CV formula. But one point to remember that with all of these methods, so with the FDR method and the CV method, once you've calculated your income for the year and returned that income to Inland Revenue, that is the only income that you need to return on those FIFs. So if you subsequently make a gain at a later date, you will not be taxed on that gain. If you subsequently receive a dividend, then you're not taxed on that. You just have to return your FIF income under one of those two methods each year, and that is the only income that you need to return in relation to those FIFs.
We've got a lot of investors out there who are interested about how they're going to be able to do these calculations. Are there any kind of tools that you can point them to that can help them with this process, Haydn?
Yeah, sure. So you've already mentioned the ASX exemption tool. So that's available on Inland Revenue's website just by Googling ASX FIF exemption. There's also a FIF income calculator on Inland Revenue's website, which can be helpful if you're trying to work out both your FIF and FDR income and CV income. And all that you need to use that tool is your transaction details during the year. In addition, there's also a foreign investment fund income guide available on the Inland Revenue website that's called the IR 461. So you could Google IR 461 or IRD Foreign Investment Fund Guide, and both of those searches will pull up the guide for you.
Yeah, just for the Sharesies investors out there, we do provide the data on transaction history, which can be used to educate or to input into the IR FIF tool, calculation tool. And as I mentioned before, we also have the Sharesies integration, and they can do the calculations for you. So we've got that DIY approach, or you can outsource it, and I understand you can do a 1 month fee for that the Sharesies report as well. And from there, My IR for the submitting to the IRD. So we have a lot of investors on Sharesies that are already over the 50k threshold and will sit under the FIF rules. How However, we also see a lot of our investors that are growing their portfolios and will be close to that 50K mark very soon. Ross, what should they be thinking about?
Yeah, I guess it's important if you're close to that 50K mark to really just check and see where you are at. If the cost of your FIFs exceeds or is $50,000 or more New Zealand in any point in the income year, then you will be subject to the FIF rules. It is only FIFs that are subject to the rules that come within the $50,000 you're measuring. If, for example, you have investments in Australian listed stocks that are exempt, they don't come into the $50,000, so you can exclude those. If you do, say, have FIFs with a cost of $52,000 in a year, that means that all of your FIFs are going to be subject to the FIF regime. You don't sort of get the first $50,000 free. If you exceed that $50,000 mark, then all of your FIFs will be taxed using the FIF regime in that year.
Just a local example, please. We have a lot of investors that say invest in a Smartshares S&P fund. Would that be a FIF fund?
To work out whether or not a fund is a foreign investment fund, what you need to look at is where the fund itself is resident. So my understanding is the Smartshares funds are actually New Zealand resident funds. So you're investing into a New Zealand entity, so the foreign investment fund rules won't apply. It doesn't matter that the fund is investing itself into foreign shares. That's not what you're looking at. You look at where the fund is resident.
Thank you both. Really appreciate your time, and thank you on behalf of our investors as well.
Thank you.
Thanks.
Once again, tax is very individual, and it's always best to seek tax advice from your accountant or advisor if you're at all unsure. Mā te wā.